Hello, everybody. This is Robert Weichelt with eXp with another episode of Weichelt Wednesday, this time with my good buddy, Jason Gordon. Jason, how are you?
I'm awesome. How you doing, Robert?
So AmeriFirst Financial, talk to me about that. You've got a lot of great stuff going on. But first, before we do that, tell me who's Jason Gordon?
Who am I anyway? Who is this guy? Well, hey, folks, I'm Jason Gordon. I'm a residential mortgage lender. Been in the business since the late 90s. I don't want to count how many years that's been, but up and down through some different market cycles, helped either personally or supervised loan officers who have helped thousands of home buyers, homeowners with their financing needs. On a personal level, I was born and raised in West LA, a little town called Venice. Came out here to go to San Diego State. And like most people who come to San Diego, once you're here, it's like quicksand. You don't leave. So happily rooted in San Diego and no plans to leave.
You know what? Born and raised in San Diego, so I can I can totally agree with you on that whole thing. Venice, though, that must have been a good time.
Let me tell you, to be an impressionable youth, just moldable, with sociology and an influence, to be on the Venice boardwalk and, there's no hair type, hairstyle, tattoo, or, jewelry or piercing that's going to phase me at this stage of life. It's quite a place to be born and raised. I'll tell you that.
I bet. Well, let's get right into it. AmeriFirst Financial, you've got a lot of great tools and systems for folks. We talked about some of the divorce, the equity buyouts, and some of the very difficult type of loans. Let's just get right into it. Tell me some of the things that you're doing over at AmeriFirst Financial that are helping borrowers achieve these goals.
Absolutely. Well, since you brought up the divorce, I'll just quickly say a couple of disclaimers here. That's not all that I do. I'm not a one-trick pony. It's about maybe 20 to 25% of my business. But in short, I'm helping in many cases here. And we all know divorce is a little bit tough to pin down into one, soundbite here. But let's just say, for example, you have a husband and a wife. They're both on title, so they own the home together. They're both on the loan together. They decide to get divorced. They decide that one's going to keep the house. That person's called the in-spouse. They stay in the home. The out-spouse is moving out, usually wants to be made whole. Maybe half the equity be removed from that loan. So let's just say, for example, easy numbers, easy concepts. House is worth $500,000. They owe $400,000. She's going to stay in the house. He's going to move out. He says, you can have the home under two conditions. I want half that $100,000 equity, which is $50,000. And I want to be removed from that $400,000 loan so I can move on with my life without that debt hanging over my head on a property I no longer own or occupy.
Sure.
So in this case, she is seeking a $450,000 loan in solely her name. And we call that an equity buyout. And there is a ton of nuances when it comes to divorce. Can you count support payments? If so, when can you count them? Divisions of debts, a lot of issues with title and other just nuances within Fannie Mae and Freddie Mac. And the thing about it is that the homeowners / divorcees know nothing about these guidelines. The divorce attorneys, they're very, very intelligent, very resourceful, but they don't teach Fannie Freddie guidelines in law school. So you have kind of this need, this niche for somebody to actually proactively learn the guidelines and help these folks out. And I can tell you that most loan officers don't seek this out. They don't get trained for it. They get the occasional divorce equity buyout just by accident. And they try to, kind of fumble their way through it. And you really have blind leading the blind. And that's where a lot of problems happen. So that's why I just took a proactive approach to get trained in it, learn, and I'm constantly being trained to help this population out.
You know what? I do a lot of divorce sales, probate sales with our unique online offers platform. And that's we were at the same event when we met. And it's interesting. That's a market that they need help just like anybody else, but it's more of an emotional market. Probate obviously is, a loss of some life, but there's that divorce is equally as, I think, as emotional because you're moving on from something that you knew, love, and trusted. And it's a very emotional time to go through that. So I commend you to dive into that market because that's a very, very, it's an important part of society. And it's unfortunately, it is what it is. Just like death and taxes, divorce is happening. So that's great. And I appreciate you diving into that a little bit. You also mentioned that's 25% of your business. Talk to me about the other 75%.
Yeah, I mean, the majority of the business are traditional sort of roles for a residential mortgage loan officer. So the two basic categories are loans for help somebody purchase a home, right? So the difference between their purchase price and their down payment is a loan that we're helping them acquire. Call that a purchase loan. If they already own the property, they may look for a refinance for various types of benefits. Clearly in this last year with, the pandemic, rates dropped to historic lows. A lot of folks did what were called rate and term refinances, where they simply replace one loan with a new one with better rates and or terms with really no cash out. And then the other type of refi that we do quite often are cash out loans, where, as the name suggests, they're pulling more cash out for various purposes, various benefits, debt consolidation, home improvements, college expenses, weddings, things like that.
Now, are you seeing a lot of cash out refinances? Because I know we got a ton of equity out there. Are you seeing a lot of cash out refinances, folks taking money out, whether that be improvements for the home or just credit card consolidation or just taking that vacation they've always wanted? I'm hearing a lot of commercials about, yeah, take your equity out and live your life, that kind of thing. And, if we remember back, 2003, 4, 5, we had a lot of equity going into that market. And then there was a whole big slew of cash out refinances. Are you starting to see some of that trend?
Well, the answer may vary in different situations here, but there's a major trend that happens. And again, doing this for as long as I have, history has a way of repeating itself. I don't want to generalize and say all blank are blank. I think that's dangerous.
Sure.
But what happens a lot in this market, and I think what's already starting to happen, is folks last year locked in these historically low rates. Let's just say, for example, you locked in 2.5% on a $500,000 rate and term 30-year fixed rate. So you got no more than $2,000 in cash out, drop down to this rate that you can't even believe when you see it on your statement, like, wow, I'm only paying 2.5% for a 30-year fix. But then people tend to spend money, whether they're using credit cards, whether they have an expense like home improvements already earmarked. What a lot of them will do is they'll get a home equity line of credit, what we call a HELOC. So it's a second lien, kind of like a credit card on steroids, where they can get, the ability to use that, pay like a credit card, where they can charge it up, pay it down, reuse it. And folks will get that for a couple of years. And they sometimes forget that these HELOCs are adjustable rate mortgages. Maybe you have a $200,000 HELOC. You thought you're only going to use maybe half of that, but before you know it, having this money tree available, now you just keep tapping into it. Now the balance is close to 200,000. And oh, by the way, whenever the Fed meets and they decided they're going to raise or lower rates, they're indirectly impacting the rate on your HELOC. And so 3 or 4 months go by in a row. Hey, the Fed raised rates a quarter, a half here. Before you know it, they're going, what have I done? This HELOC now is a $200,000 balance. I'm paying about 7.5%. I should consolidate the two of them together now. So so whatever they have now, it's oftentimes short-lived because they've got this other thing going on in the background. I would say, if that's even a possibility in your world right now, as we're speaking in July of 2021, I would pursue a cash out refinance now, lock in one low rate for a 30-year fixed, and have your money locked in as opposed to on that roller coaster.
You know what? I was thinking the same thing. It's so easy. They make it, a lot of the lenders, they'll make it more easy as it becomes more popular, but it's easy for them to get that equity line of credit, and they forget, like you mentioned, that it becomes an adjustable rate, and then it gets tapped out. And next thing you know, you've got this fluctuating second trust deed. And then who knows, if the home prices fluctuate and start to go the other direction, that could be a very, very bad thing. But if you lock it in at a historically low rate, like what we're experiencing right now, it seems to be the safer bet.
Agreed.
Yeah. So that's great. So tell me, what other kind of things are you doing out there to help your agent community, the realtors, and helping them grow their business?
Well, I'll tell you, there's 2 answers I can give you. I'll give you one real quick, and if we have time for the second one, I'll do that one too. But a very common buyer in the market right now is somebody who is selling, we'll just call it property A, in order to buy property B. Our legal word is, we call it a contingent purchase, right? You're buying B contingent on A selling first. And there's usually a couple of reasons why a buyer might do that. Number one, they can't qualify with both A and B's mortgages against their income from a cash flow perspective.
Sure.
Number two is that they need the profits when selling A to bring in as the money to bring in for B, or C would be a combination of both of those, right? And so these are bona fide approvals, but in this kind of market right now where you've got supply and demand playing a big role, where you have this big supply big demand of home buyers chasing a short supply of available homes, the leverage now goes on the sellers of those B properties. And in this case, that homeowner will have no problem selling A. They're having a problem getting the seller on B to accept an offer contingent on A selling, because none of that B seller has no idea who these A buyers are. It's another element of complexity, which may be wrong. So it's a shame, because you have these really good buyers who want to basically create two different households, right? They want to sell A and allow some people to buy that property. They want to move into B, maybe their dream home. And it's been a real problem over the last year or so. So what we're doing at AmeriFirst Financial, and I was really blown away when my CEO called me and told me about it, because it's something that, number one, you don't get a lot of phone calls from your CEO. When you do, this kind of news is pretty cool. So we have a program now, for at least for now, we're just calling it the buy sell program. Not the most creative terminology, but for qualified clients, we are buying B with cash for them so that they can then sell their A and only have to move once. Because in the alternative, either they're not getting their offer accepted, or they're getting in these bidding wars, trying to get the attention of that seller and say, well, how about if I pay you more money? Well, now they pay 30, 40, 50 grand more for a property than it's worth, just so they don't have to move twice. Or they pay market price, but they sell A, they live somewhere temporarily for a while, then they go to buy B on their own. Not really ideal for a family, especially around, when school comes back in now. You're going to move your kids twice in a 6-month period? Probably not. So for us buying B for them with cash, we're allowing them to then comfortably sell A, move into B, knowing that's already there for them.
That's a game changer, in my opinion, working with many sellers that need to sell A to get B. And A is still actively on the market because they don't want to take that, sure, you can put in there seller to find suitable housing contingency and all that, but nonetheless, it's still a contingent property when you go to find B. And as a listing agent, I'm looking at it going, well, I've got a non-contingent offer and a contingent offer. I'm going to go with the strength of the non-contingent.
Yeah.
And this right here sounds like it might be the solution that agents need to know about. I mean, that's
100%.
fantastic.
Well, you think about how lenders think anyway. Lenders and insurance companies, they look at each scenario as a probability of risk, right? That's how we look at it. That's the lens we look at life through. So a listing agent helping that seller on property B, they're going to whisper in that seller's ear and say, look, I know this one client's going to pay you $5,000 more, but we have this whole other issue with the buyers on property A. What if?
Yeah, sure.
Let's take the bird in the hand here and get this thing done. And I can't knock the listing agents on B for saying that. I can't knock the sellers on B. I mean, this makes sense. It's an unfortunate logistic, but so I feel like we're really solving an issue right now. I don't want this to sound like a big sales pitch, but I'm really proud of kind of the think tank that is at the top of our hierarchy at AmeriFirst Financial, because we look at ourselves more as partners of real estate agents, not just resources. Right? A resource is like hiring a plumber. Hey, do this job and just do it right, and don't make anybody mad. And here, I'll keep giving you more business. That's not how we want to be. We want to be a partner. Yeah. We want to feel that same pain you're feeling, right? And if you're like, hey, I can't get these contingent buyers into new homes, it's costing you two different sales, right? The sell of A and the buy of B.
Sure.
What if we found a solution? I think we did.
Yeah. You know what? It's as a listing agent, and a lot of my sellers, like I said, become buyers. This is a great solution. So I'm really glad you brought that up. You brought up the fact that you've got some really deep background on the divorces, because there's a lot of moving parts with divorces. I just closed one where Mr. and Mrs. they weren't talking, so it was a lot. There's a lot of moving parts in divorce. You also talked about how you've been in the business a long time, so there's not a lot you haven't seen, but you brought up a product that is powerful. So I really appreciate that, and I'll go ahead and make sure that the crowd gets your information because they need to get a hold of you because that's a game changer, my friend.
Appreciate
so
that.
so in closing, what would you like to say to the agents or attorneys or borrowers that are tuning into this? What's the message you'd like to tell them?
Oh God, there's so many messages I would like to tell folks right there if I had an open platform and everyone would listen to me. Real quickly, for compliance reasons, my NMLS number is 259027. That keeps my attorneys happy for me telling you who I am.
Yeah.
My e-card that you can get all information about me, just go to vipborrower.com, vipborrower.com. Take you to a whole bunch of just information about me if you ever want to know who I am, what I'm all about. As far as friendly advice, we live in a soundbite generation, right? 30-second commercials. If you think you're going to get all the information you need to get in a 30-second commercial on choosing someone as important as a lender for the biggest debt of your life, I encourage you to think bigger. If you can't Google the first name and last name and the word mortgage, first name and last name of the loan officer and the word mortgage, and get information about them, about what they do, then you're probably working with a transactional lead converter who is really not going to have much of a vested interest in you when that loan funds and they get paid.
Good
and
point.
I encourage you with your family, your friends, those who you care about, pass that advice on. Okay. These are high-end issues like legal, like medical, like high finance. Don't bargain shop and get somebody who's not going to do a good job because there's so much to lose if you pick the wrong person.
Wow, that was pretty powerful. You know what? Thank you so much for that. You've dropped some bombs, some really great nuggets on us. And I knew getting you on this program would be just nothing but beneficial for the listening audience. So Jason, I tell you, my friend, thank you so much for being my guest today. This is Robert Weichelt for another episode of Weichelt Wednesday. Tune in next week.